Sense is run by a bunch of investment bankers, and their modus can help make
Goedendag, welkom bij Morningstar. Vandaag praten wij met Oliver Kettlewell. Hij is fondsanalist hier bij Morningstar. En omdat hij Engels is, zal dit gesprek ook in het Engels verlopen. Oliver, welcome.
Thanks, Sander.
Before we talk about dividend funds, let's start off with dividend stocks. Is there such a thing as a typical dividend-paying company?
Yes, well, in theory, any stock-listed company can pay a dividend, but in reality, dividend-paying stocks tend to come from mature industries. So they tend to be companies that have a sort of proven product that's sort of generating cash, recurring revenue streams, and this then enables the company to then pay the dividend. If for example, we take the case of dividend fund managers, they usually like to make the case of dividend cash in your hand is worth more, is more reliable than the fact of perhaps stock price appreciation.
So dividend-paying stocks are less risky. Does it translate into dividend categories being less risky than other categories within our Morningstar categorization?
Yeah, I think so. And in fact, I think that dividend funds is one of the most risk-averse ways you can play the equity market. I had a look in Morningstar Direct database, our database here at Morningstar, and I found that dividend funds tend to have a lower standard deviation of returns, so lower volatility, compared to some of our other more popular categories such as growth funds and small caps in emerging markets. So yes, there is an element there that the sort of stability of a dividend company is then translated through to relatively stable dividend funds.
So Oliver, you talked about the benefits of dividend funds. There must be some risks as well. What about the value trap?
The value trap is a problem. It's a good question. The value trap is when a stock price is trading cheaply, say trading cheaply relative to its historical average or relative to peers, and therefore the fund manager buys a stock in anticipation that it will then rebound back to its long-term average. However, of course, the value trap could mean that the stock is cheap for a reason, because it's a bad stock, and so the fund manager could buy the stock and the price could continue to fall, and in the worst case scenario the company could go bankrupt, so then you would lose your stock value and you would lose your dividend.
And how does the value trap affect dividend portfolio managers?
Then portfolio managers can become trapped, if you like, in this value trap, because they can perhaps look for dividend stocks paying out a high dividend yield. So therefore the stock is trading very cheaply, and that would then make the dividend yield appear attractive. The way that fund managers who have dividend strategies can avoid this is by looking more at the sort of sustainability of the dividend. So can the company who's paying the dividend, can it does it have the ability to pay this money into the future?
Well, most of the major fund houses in the Netherlands offer dividend funds. Which one do you prefer?
I think the highest rating dividend fund that's managed here in the Netherlands that we've rated is the Kempen Global High Dividend Fund. It's received our superior rating, which is our second highest rating that we've awarded. Yeah, I mean, we like the fund here. It's got a disciplined dividend investment process because they screen for stocks that have a minimum dividend yield of 3.3%. However, they avoid the value trap, which I just talked about, by then looking towards the future. So can this company sustain a dividend payment? And the way they do that is by looking at earnings. They look at the business model of a company. They look to see how much free cash flow there is. So they've got a lot more factors instead of just the dividend yield they're looking at.
And why is that?
The team has been together for about 10 years. They've only got a track record of 3 years here at the Kempen Fund, which I mentioned, but they were also at ING before Kempen, running a virtually identical type of dividend fund. And again, I had a look into our Morningstar database, and I found that if I took the track record of their 3-year period at Kempen and their 7-year period at ING, in 9 of the 10 years they beat the average peer in this category. So it's a good track record. And one other thing, which I think is good to mention about this fund, is that the portfolio managers self-invest in the fund. Okay. So it's aligning their interests to those with shareholders of the fund, which I think is also always a good thing to do.
Okay, Oliver, thanks for giving us some insights into dividend investing. U bedankt voor het kijken en voor meer achtergronden kunt u altijd terecht op onze website www.morningstar.nl.